As we conclude our comprehensive exploration of arbitrage trading, it's evident that this strategy remains one of the most compelling and dynamic approaches in the financial markets. Throughout this series, we've delved into foundational concepts, advanced strategies, technological advancements, and the psychological and regulatory aspects of arbitrage trading. In this final video, we'll summarize the key takeaways and insights from our journey, highlighting the essential elements that drive successful arbitrage and preparing you for future challenges and opportunities in the field. Section 1. The core principles of arbitrage trading. At its essence, arbitrage involves exploiting price discrepancies across different markets or instruments to secure a risk-free profit. This simple concept, however, requires a deep understanding of various factors and the ability to act swiftly and decisively. Understanding price discrepancies. The fundamental principle of arbitrage is identifying and exploiting price differences. These discrepancies can arise due to various factors, including market inefficiencies, differences in supply and demand, and regulatory constraints. Market inefficiencies. In many cases, markets are not perfectly efficient, leading to temporary mispricings. Successful arbitrageurs continuously monitor markets to identify these inefficiencies and act quickly to capitalize on them. Supply and demand. Differences in supply and demand across markets can create arbitrage opportunities. For instance, a commodity may be priced differently in two markets due to local supply constraints or varying demand levels. Regulatory constraints. Regulatory differences between markets can also lead to price discrepancies. Traders who understand these regulatory environments can exploit these differences for profit. Key strategies in arbitrage trading. Throughout this series, we've covered various arbitrage strategies, each with its own set of techniques and applications. Some of the key strategies include statistical arbitrage. This strategy involves using statistical models to identify mispricings between related assets. By analyzing historical data and patterns, traders can predict price movements and execute trades accordingly. Merger arbitrage. When a merger or acquisition is announced, the target company's stock often trades at a discount to the proposed acquisition price. Traders can buy the target's stock and profit once the deal is completed. Convertible arbitrage. This strategy involves buying convertible securities, like bonds or preferred shares, and shorting the underlying stock. The goal is to exploit pricing inefficiencies between the convertible security and the stock. Triangular arbitrage. In the foreign exchange market, triangular arbitrage involves trading three different currencies to exploit discrepancies in their exchange rates. This strategy requires quick execution and precise calculations to lock in profits. Section 2. The role of technology in arbitrage. The integration of technology has significantly transformed arbitrage trading. Advanced tools and platforms have made it easier to identify and exploit opportunities while also introducing new challenges. Algorithmic and high-frequency trading. Algorithmic and high-frequency trading, HFT, have become dominant forces in financial markets. These methods rely on sophisticated algorithms and high-speed data connections to execute trades within milliseconds. Algorithmic trading. Algorithms can process vast amounts of data and execute trades based on predefined criteria such as price, volume, or timing. This automation reduces human error and increases the speed of execution. High-frequency trading, HFT, involves executing a large number of orders at extremely high speeds. This method allows traders to capitalize on small price discrepancies that exist for only fractions of a second. Artificial intelligence and machine learning. Artificial intelligence, AI, and machine learning, ML, are becoming increasingly important tools in arbitrage trading. These technologies enable traders to analyze large data sets, identify patterns, and execute trades more efficiently. Predictive analytics. AI and ML can forecast future market movements based on historical data. By identifying trends and patterns, traders can anticipate price changes and adjust their strategies accordingly. Sentiment analysis. AI can analyze textual data from news articles, social media posts, and other sources to gauge market sentiment. Understanding market sentiment helps traders anticipate how news and events might impact prices. Blockchain and decentralized finance, DeFi, blockchain technology, and the rise of decentralized finance, DeFi platforms, are transforming financial transactions. These innovations offer new opportunities for arbitrage by enabling the seamless trading of digital assets across borders. Smart contracts, self-executing contracts with the terms written into code. Smart contracts automate complex trading strategies and reduce the need for intermediaries. Section 3. Navigating challenges in arbitrage trading. While arbitrage trading offers significant opportunities, it also comes with challenges that traders must navigate to succeed. Managing risk. Effective risk management is crucial for long-term success in arbitrage trading. Traders must be adept at identifying and mitigating various risks associated with their strategies. Market risk, the risk of losses due to adverse price movements. Traders can use hedging strategies and diversification to manage market risk. Counterparty risk, the risk that the other party in a transaction may not fulfill their obligations. Selecting reputable counterparties and using collateral can mitigate this risk. Liquidity risk, the risk of not being able to buy or sell an asset without significantly affecting its price. Traders should assess market liquidity before entering positions and use limit orders to control execution prices. Regulatory and legal considerations. Regulatory and legal considerations play a significant role in arbitrage trading. Traders must stay informed about the regulatory environments in which they operate and ensure compliance with relevant laws. Regulatory arbitrage. Exploiting differences in regulations between markets can be profitable, but requires a thorough understanding of the legal landscape. Compliance. Ensuring compliance with laws and regulations is essential to avoid penalties and legal issues. This includes understanding tax implications, reporting requirements, and trading restrictions. Adapting to market changes. The financial markets are constantly evolving, and successful arbitrageurs must be adaptable and innovative. Staying informed, continuous learning, and staying updated with market developments, technological advancements, and regulatory changes are crucial. Given the rapid pace of change, especially with the rise of technology-driven trading platforms, staying informed enables traders to anticipate shifts and react proactively rather than reactively. Access to real-time data and insights can empower them to make well-timed decisions and maintain a competitive edge. Innovating strategies. As markets become more efficient, traditional arbitrage opportunities may diminish. Traders should innovate and explore new strategies to stay competitive. For example, algorithmic trading and machine learning are now widely used to identify complex patterns and anomalies that human traders might miss. Risk management. In an environment where rapid changes can lead to significant price volatility, robust risk management practices are essential. Adapting to evolving risk factors, such as geopolitical events or sudden market shocks, can be just as important as capitalizing on arbitrage opportunities. Effective risk management managing risk is fundamental to long-term success in arbitrage trading. Traders must be adept at identifying and mitigating various risks, including market risk, counterparty risk, and liquidity risk. Implementing robust risk management strategies is essential for maintaining profitability and stability. Understanding regulatory environments. Regulatory and legal considerations are integral to arbitrage trading. Traders must stay informed about the regulatory environments in which they operate and ensure compliance with relevant laws. Understanding tax implications, reporting requirements, and trading restrictions is essential to avoid legal issues and penalties. Adapting to market changes. The financial markets are constantly evolving, and successful arbitrageurs must be adaptable and innovative. By continuously learning, staying informed, and exploring new strategies, traders can navigate the complexities of modern financial markets and seize emerging opportunities. Future outlook. The future of arbitrage trading is promising, driven by technological advancements and increasing market integration. As blockchain, AI, and quantum computing continue to evolve, they will reshape market dynamics and create new forms of arbitrage. Traders who stay ahead of these trends and adapt their strategies accordingly will be better positioned to capitalize on emerging opportunities. As we wrap up this series on arbitrage trading, we hope you've gained valuable insights and knowledge to guide your future endeavors. Whether you're a seasoned trader or just starting out, the principles and strategies discussed here provide a solid foundation for success in this exciting and ever-changing field. Remember, continuous learning, leveraging technology, effective risk management, and adapting to market changes are key to staying competitive and profitable in arbitrage trading.